Why don't
Yeah,
you lead it off and talk a little
sure.
bit about WFG and whatever you want to talk about, and then I'll get going.
Sounds good. So thank you guys for joining us. We appreciate the time. We know that everyone has such stretched schedules right now, and everyone's laying the seeds for that spring season. So we do appreciate your time. WFG is a national company, as you may or may not be aware. We are one of six national underwriters, so we can service your transactions all over the U.S. We do commercial, residential, refinances, all the things. So I don't know who invited you to the meeting, but please reach out to them to learn more about WFG and the tools that we have to offer our agents to help grow your business. And we're super excited to have Craig. Craig O'Boyle is with Assumption Solutions. He is a 30-year real estate agent, so he knows your pain points and also is been around to experience the ups and downs of the market. So he opened up this business with a partner back in 2022, and I'm going to let him take it away with that and give you a little bit about his background. Thanks for being with us, Craig.
Thanks for having me. I very much appreciate the chance to communicate with anybody about this topic because I think it's the best thing going in real estate right now. So I'll just start it right off. Hopefully everybody can see the slideshow here. Um, we'll have a little bit of chance to hopefully not be too dry and laugh occasionally, but you have to put up with my sense of humor here. So interest rates, when bottoming out, is a good thing, right? How low are interest rates on assumptions? Well, about as low as this pickup truck that I shot a photo of in a Home Depot parking lot. And I felt very proud of myself that I could make my own meme here. So anyway, all right. So what we're going to talk about today, we'll do a mortgage loan assumption overview, the assumable loan types and eligibility, the value of a loan assumption, which is actually my favorite topic, and I think when you master it, really can help you grow your business. We'll talk about the assumption process and steps that we help take you through, the pricing for assumption solutions to help you through the process, the evolving market, the things have changed since we started this business in 2022. And then I'll put my real estate agent hat back on for the last part of the class, and we'll talk about closing more deals. All right. So, a mortgage loan assumption overview. A mortgage loan assumption occurs when a buyer agrees to take over the existing loan of a seller, becoming responsible for its repayment. There are two types of assumable mortgages, qualifying and non-qualifying, although non-qualifying assumable mortgages are now extremely rare, if not non-existent. We would see them occasionally in the early 90s. I got licensed in 1995, and they were leftovers from the late 80s.
Mm.
After the late 80s, basically the government made all assumptions be qualifying. They got rid of the non-qualifying, but they were great when they existed. If we saw them in the MLS, we'd run out the door and try to buy it ourselves because you didn't have to do anything except say you wanted to take it over, and the seller had to agree. Most assumable loans require that the buyer meet the same qualification standard as the original borrower when the loan was issued. Nearly all qualifying assumable mortgage loans are either VA or FHA guaranteed loans. I will say the reason it says nearly is USDA has some assumability, but we don't work in that space because we have seen that the truth is the seller may not be fully released from liability, and the banks have some discretion whether they even allow it or do it. So VA loans can be assumed by both veterans and non-veterans. However, only when the assumption is made by another veteran with sufficient VA entitlement will the original borrower's entitlement be released from the loan by substituting the new buyer's entitlement. So, a lot of people don't realize that you do not have to be a veteran to complete a VA assumption. Entitlement is what you earn when you have served the nation and become a veteran and you get a loan. And if you think of entitlement, you think of it kind of like a dollar amount. You have a certain amount of dollar value that you can have VA loans within. One, two, I mean, depending on how low the loan amounts are, maybe even more. But if you allow a non-veteran to assume your loan, the amount of entitlement you used to get that loan will remain tied to it until that loan is paid off. And what that means for the seller is it means you have either reduced or eliminated your ability to get the next VA loan, depending on how much of that entitlement is used up. So, what I tell agents, we see in our company anywhere from 3 to 4 out of 10 deals go to non-veterans. And the reason we see that happen most commonly is, well, there's several. Number one is maybe somebody is elderly and they do not plan to need or use their VA entitlement again, so they're okay with leaving it. We've seen scenarios where there's two spouses that have entitlement and they can always use the other spouse's entitlement and leave one there. And then the third most common reason sometimes is just whatever the heck gets the house sold. They need to have this thing sold, so they're willing to allow their entitlement to remain to get the deal done. FHA loans are also assumable. They do not involve entitlement issues like VA loans. However, they do require that mortgage insurance for the entire duration of the loan is part of the payment. So there's a little bit higher cost in the payment with an FHA loan, but it doesn't have an entitlement issue like VA does at all. Now, both VA and FHA loan programs are primarily intended for owner-occupant purchasers. However, there are some changes to that with VA that I will talk about when we get to the evolving market slide. FHA cannot go to an investor assumption at all. It has to be an owner-occupant. All right. Now I'm going to go to the monetary value of a loan assumption, and this is my favorite slide. There are 4 pillars in here that I'll talk about. The more you can master all of these, the more deals I think you'll do in this space, and the more you will understand the wealth that can be created from doing an assumption. So, first thing we're going to talk about is a payment comparison. We're going to look at a $400,000 loan at 7% interest, which is equal to a monthly payment of $2,661. And we're going to compare that to a $400,000 loan at 2.75% interest, which is not the lowest of the low. I mean, it's pretty common that we see. I mean, we've processed as low as 1.75. So keep in mind, these numbers obviously can shift because even 7% right now is a little high for what's out there in the market. But this is great numbers to know. That 2.75 yields a payment of 1633, which is a monthly savings of $1,028, which is an annual savings of $12,336. This right here, I like to say, is the headline number that gets people really attracted to doing an assumption, right? What buyer in the marketplace doesn't want to save $1,000 or more a month in their payment? So that's the big deal to understand and how to show people when they're thinking about doing an assumption when you compare and contrast numbers. The next vertical we're going to talk about here is the change in purchasing power or purchasing power comparison. This is what we saw as 22 changed from low rates to high rates in 2022, the reduction in buying power. So a monthly payment of 1633 is that 400,000 at 275, or it's only 245.5 at 7%, right? That's a decrease in purchasing power of 154.5 to keep the same monthly payment. That is your buying power is reduced to only 61.4% of the previous level in that scenario. This is what took so many people out of the market. This is why, in many cases, we're seeing sales volume at levels that we were seeing way back in the 90s, right? With probably 100 million more people living in the United States. So this is what everybody has felt. Now we'll look at the vertical next that I think is where people really make their money over time. The people that understand this are the people that are sometimes already wealthy or the people that are really on the path to becoming wealthy. interest saved over time with an assumption, right? So total interest paid on a $400,000 loan over 30 years is $558.36 at 7%, or only $187,868 at 2.75%. That means total interest saved over 30 years is $370,000. That is a massive amount of savings just by the change in interest rates. Now we're going to run a little exercise for the remainder of this section here. We're going to pretend that this property came on the market 3 years after that loan was taken out and is going to be assumed. So interest paid on the first 3 years of the 2.75% loan was 31,938. So when somebody comes along to assume it, they are only going to have a 27-year loan. And because interest is front end loaded, every year that you go through that loan, right, the greater amount of principal that goes in your payment. So when you make this assumption of this loan, your total savings versus new financing actually exceeds the original loan amount. Your interest saved is 402,106. So you're exceeding the original loan amount in interest saved by over $2,000. When you understand this kind of math, when you can run these kind of scenarios, which you can do off an easy Google amortization calculator for clients, it's a no-brainer. This is the best thing in the marketplace. Matter of fact, if my kids who are starting college right now get to the point where they're going to buy a house, this is what dad wants to help them do. This will set them up for their future. Um, so now the last column I'm going to talk about here was not something we anticipated when we started this business and this company, and that was older loans with higher interest rates. We didn't anticipate this, but we did this very transaction that I'm going to talk about. And this, when I realized what we were going through, it kind of taught me that there's lots of longevity to this space. Right now, everybody wants the best interest rate, but sometimes when you're working with an amortization schedule, just the fact that it's gone through the amortization schedule might make sense. So we did a deal where there was a $500,000 loan originated on the house for sale at 5.29 back in 2009 and had a payment of 2773. The remaining loan balance 15 years later had been paid down by 2023 to 358,759. The house had obviously appreciated, so it had come on the market for 900,000, and it had what we call an assumption gap, meaning the gap between the loan and the price of 541,241. There are a lot of sizable gaps in the marketplace because of the appreciation we saw from 2020 through 2022 and maybe even continuing on. But this one had a big one. Now, this buyer of this house sold a home in Hawaii, was transferring with the military here, had that money in cash, so he could do it, right? Now, the interest paid by the seller over the first 15 years of that loan was 336,421. That was just the interest that they paid. But interest in an amortization schedule is front end loaded. So that means for the remaining term, only $164,000 in interest, along with the remaining principal, needed to be paid. So just by coming into the loan because it was so far through its term, right, even though the rate was higher, the bulk of the interest had been paid on this loan. So I'm not afraid to say that even if the rate isn't terribly low, if the loan goes through term for quite a while, it might make sense to do the assumption. So we'll see. We've seen many loans even originated since 2022 that as they get further into their term, let's say 2030, 2032, I know that those dates are coming, but they may make sense to do an assume because even though the rate's higher, right, a lot of the interest has already been paid out of them. So keep that in mind. All right. Hopefully nobody's glassy-eyed from numbers. Let's move on to the process. So whether you're working with a buyer or you're working with a seller, you want to confirm the property has an assumable FHA or VA loan. Now, all VA and FHAs are assumable, but you got to confirm that it's got those loan types. And this is something that I think WFG could help you out with because they can pull, in many cases, the deed of trust, and the deed of trust should contain an FHA or VA case number. So review the existing loan documents carefully. All parties should pay close attention to the loan amount, the interest rate, and the payment terms. Those are the asset that you're either selling or buying, depending on what side of the transaction you're on, right? Obtain an ownership and encumbrance report from the title company to confirm that the loan is indeed an assumable FHA or VA loan. Ultimately, you're either marketing the property or you're looking at them with buyers, and everybody says, hey, this is a go. So you're going to execute an assumable purchase contract. We do this in all 50 states. Every state is different. Some states actually have sections of the contract that deal with this. We do in Colorado. It's funny, we've had to train a lot of people because most people just never even knew it was in our contract. So check your state contract. If it's not there, you may want to work on language that you get from an attorney or colleagues or some other scenario. But the servicer assumption approval, the mortgage company who serviced the loan, generally will take anywhere between 45 to 120 plus days, averaging 60 to 90. Now, I will say that this slide is a little bit old. I would say the average is actually closer to 60. With any average, though, keep in mind some are quicker, but some are slower. So if you plan for at least 60 minimum, I think that's wise, right? Some deals go 45. We've seen some deals go as fast as 30. You can call us to check your servicer if you know them because we track every deal we do, and we can generally give you what we have seen as the trend for that servicer recently, like maybe the last three deals with them. But keep in mind, that's not a guarantee as far as fast as they will go. That is because the biggest thing that affects them is the volume of deals that they're working on. So, excuse me. All right. Now, buyers need a plan for the gap between the purchase price and the loan amount. Usually, it's a cash down payment, but I will address some changes to that we have seen in a coming slide. Flexibility and advanced planning are essential as the process may take time. Have conversations with both sides of the transaction. If somebody's absolutely got to be done in 30 days, an assumption may not be for them because the servicer just doesn't care what your contract says as far as deadlines go. All right, send the contract to Assumption Solutions. This is what we hope you do once you've got it executed. We're here to be your easy button for getting through this as much as possible. We function as your assumption transaction coordinator. Assumption Solutions will vet your transactions to determine if we can help you be successful rather than you waiting weeks or months for servicers to review your submissions. On average, they don't even look at a submission at the servicer for at least 2 to 4 weeks. That's a heck of a long time to be stuck in a deal not knowing if it's going to work. And my team that reviews every file and walks it all the way through to the finish is made up of multi-decade lenders, and at this point, we've probably done more assumptions than anybody in the United States. So we'll help you navigate submission once we have vetted it to ensure the servicer, to ensure that when they get it, the servicer, it's done right the first time and no errors are there because errors will lengthen your timeline. What the servicer will do if there's an error, they'll kick it out. You got to resubmit and you go to the back of the line, right? So you're starting that clock over. And believe me, the servicers have no motivation to do these deals well. Matter of fact, for them, if you think about it, right, they don't make money doing them. And if they get rid of low rate loans, who wins? They get to lend money out at a higher rate. So having somebody that knows how to do this correctly and is there to catch the errors that they make, which they frequently do, is key. All right. Now, servicer is ultimately the one who makes this assumption approval, right? Assumption Solutions will then continuously and regularly follow up once it's submitted with the servicer to ensure they're moving the file forward. Will help you understand the process at each stage and adapt as needed and correct errors as needed and deal with conditions that come out. The servicer takes in and processes the assumption application. Once they grant assumption approval and clear to close, closing can be scheduled with the title company. From there, it's going to basically move from the assumption department at the servicer to the closing department. And that's when they're basically coordinating figures with Tammy and her team over at WFG. Now, timelines may vary. So once again, remain flexible. You know, if you've planned for a 60-day deal and it's 59 days, it doesn't mean kill it, right? You may just need to extend it. It may get done in 62 days. You don't know, right? So everybody should be as flexible as possible. All right. Now, another little humor break here. So, navigate a complex process with experts. Teamwork makes the dream work, whether it's with realtors, title company, inspectors, or us at Assumption Solutions, right? So, for real estate buyers, we've got a little before and after with 4 people here. You can see the first 3 people who did not use you as an agent. They don't look really good at the end of their transaction except for this guy in the lower right corner. He looks pretty happy that he used you. Well, we like to make sure you don't look like the people at the end of your assumption deal because you've pulled your hair out trying to deal with a servicer because they don't make things easy. All right. I know, bad jokes. All right. Obviously, if you go with us, we charge a fee. I know, shocker, right? Assumption Solutions charges each party a $950 fee, totaling $1,900 per transaction. The first $50 is due at engagement from each party, with the remainder payable only if the servicer assumption approval is issued. We are low cost, low risk, high value. So 1900 total, 950 per side. If you negotiate it that way, it's split. It can also be paid by one party. The second most common thing we see is where people negotiate the buyer paying the fee because a lot of times the buyer's getting kind of the best deal in an assumption. Now, outside of that, the servicer government costs, there's processing fees, but they're often under $1,500 from the servicers. Government entity fees, well, on a VA loan, there's a 0.5% VA funding fee, which is waived with a qualifying VA disability. Um, that's significantly lower than the funding fee on a new loan. But the difference is with the new loan, you're often rolling it into the loan, so the loan amount goes up. In this, it's paid in cash. Now, in most cases, completing a mortgage assumption costs less than securing new financing. One of the things you don't have as well, you actually don't have even the appraisal fee because the appraisal on the loan was done when it was originally taken out. So the cost of doing an assumption usually is less. All right, so we'll do some quick examples here. Buyer and seller splitting the fee, 950 per side upfront, $50 engagement fee. Assumption approval and clear to close is issued. The remaining 900 per side is invoiced. And we invoice all fees outside of the closing. We do it when assumption approval is issued. We view our role much like an appraiser or inspector or any service provider. We're not success based as far as closing. We're success based on getting you to clear to close. So we bill them directly via Square. One party paying the fee, the buyer, seller, or a third party. We've seen that. 1900 means a $100 engagement fee billed up front and 1800 invoiced at clear to close. All fees are billed outside of closing. In either scenario, if assumption approval is not achieved, the only fee collected is the $50 engagement fee per side, which is paid up front. Low cost, low risk, high value. And I will mention there's competitors in the market space that have come along after us. Most of those competitors charge 1% of the sales price. So we are absolutely the low cost leader in the space, not to mention the original. All right. Now let's talk about the evolving market, things that have changed or things that are also important to know. Because this has been, since we started it, what I call the Wild West of real estate. When we started this back in 22, a lot of the servicers didn't even know they were required to do these. They thought it might be optional. So we've worked through training a lot of them. We've done a lot of deals since then, and most of them have gotten better, but some things have changed. So number one, when we started, the occupancy requirement was owner occupant only, and that was pretty firm. But then things started to kind of flex, especially in VA. Sorry, I skipped ahead there. VA kind of made the decision that really that wasn't a big deal with regards to owner occupants. So they started allowing investors to purchase VA for assumption. But there's a couple caveats. If an investor does it, the seller's entitlement must remain attached to the loan. So what that means is their ability to get that future VA loan will be reduced or eliminated depending on how much entitlement was used until that loan is paid off. Now, for investors, they have to buy it in their name. They cannot do it in the name of an LLC or a company or anything like that. So I do not anticipate that we will see like large Wall Street backed type investors in this space. But we have seen clients, or we have helped clients that have bought multiple assumptions. We have one right now. I think he's in the process of doing two currently. So if you have investors, this is the best option to getting a property to cash flow. So a great space for people looking to invest. FHA, owner occupant only. No flex there. So just VA that you can do it. The potential for obtaining secondary financing has always been the number one question that I have got. When we first started, there was no option for secondary financing for the gap. Then, truth or rumor, I don't know, but it started getting out there that VA and FHA would allow it if the secondary financing was assumable, and assumable seconds did not exist. Then they finally came out and they basically said, you know what, we don't care. As long as it doesn't mess with our loan in first position, we don't care. So there are products out there that will bridge the gap with secondary financing, but there's still caveats to that. A secondary position, most of those lenders have muscle memory of the wipeouts that happened in the Great Recession. So they're not willing to go 100%. So generally, you're going to need about 10% of the purchase price still down in cash. So if your gap is less than 10% of the purchase price, you're probably not going to be doing secondary financing at all. If your gap is greater, you can do secondary financing, but you'll have to understand it's a purchase money HELOC usually. So that rate is Fed funds plus a spread. What we have seen is commonly between 8 and 10%. So if you do too big of a second, you're probably going to wipe out the benefit of doing the assumption because you're going to have a huge second and a first at a low rate, and they're going to equal probably rates that are available today. So if your second is significantly smaller than your first, it will still make sense. And so we are seeing people doing that. I want to be clear though, we still see most of the assumption deals we're involved with go without secondary financing at all. And the average gap we are seeing people fill is anywhere between 50 and 75,000 in cash. There are a lot of people out there that have these funds and are doing that. I don't want to say that it's as big as if you could get 100% financing, but it's big. And we've seen deals where we did a $2 million sale in Scottsdale where the gap that was filled was $1 million in cash. So this isn't all price points at all levels. So keep that in mind. But secondary financing is there. We're not involved in that process. We know some people involved in that process. We can connect you if you reach out to us. All right. The 45-day transaction timeline rule. Sorry. Why am I clicking those? So a lot of people had heard early on that the VA had a rule that this was supposed to be done in 45 days because they issued a new circular. It wasn't new. Both the government entities have said that these should not take longer than 45 days. They reissued that rule, but here's the problem. They're not enforcing it with any kind of teeth, right? And so that's why we still tell people, even if you've heard these have to be done in 45 days, you need to be flexible because until there's teeth and these lenders are getting bitten for not meeting it, right? they're getting away with going longer. Now, a lot of them are trying hard to meet this, but their trouble is not enough staff for the volume that's coming in and not enough cost benefit to hire that staff because they're just not able to charge to do it. So, all right, the handling of escrow accounts, which obviously matters to Tammy, I would say this is the real Wild West. It's getting better, but it's not standard. Whatever the servicer says is going to happen with the escrow account is going to happen if you want the deal to close. They are getting better with, regards to, in a normal sale, everything that's in there gets refunded to the seller. But in this case scenario, there could be shortfalls and deficiencies depending on when taxes and insurance were paid. The buyer's going to get a new insurance policy, so the payment can change depending on what that new policy is going to run the buyer. So there's some things to work through, but be flexible. Make sure your clients understand that likely they'll get all of their escrow back, but there could be some pieces that they don't, or there could be some issues with the fact that it's short that needs to be made up. So that new buyer is actually going to have a little bit of a higher payment for a period of time. So keep that in mind. VA eligibility restoration timeline. This speaks to when a buyer and a seller are both veterans and they do an entitlement swap. The VA entitlement swap takes place post-closing. It's not something we're involved with. The guidelines with the VA when a swap is taking place is that the servicer has 45 days to notify VA of the swap, and VA has 30 days to reinstate the entitlement so that the buyer can purchase with their entitlement again. So what that means is you may not be able to go from closing to closing like you can do in a new loan. I hope this changes. This is a legacy thing. There's really no reason for it, but it exists. The seller has to stay on their servicer to say, hey, reinstate, let the VA know that we've done a swap, reinstate my entitlement. We have found VA will be pretty quick, but they can take up to 30 days. So potentially 75 days. So keep that in mind. We haven't seen it be a major roadblock to assumptions. We've seen people plan around it. We hope it gets better, but keep that in mind. You may not be going from closing table to closing table. All right, one more little laugh here. Closing more deals. They said it would be easy in real estate, right? Well, being a real estate agent is the least stressful career I've ever had, said Jessica, who's obviously 29 years old. Well, assumptions can speed this process up for you. So make sure you have us as experts to help you. All right. Okay, I'm swapping on my real estate agent hat here, and we're going to talk about ways to get more buyers, ways to get more sellers. We're going to talk about when you get the listing, which I think is the best scenario to be in, how to properly market that listing. And then I'll show you some other things that are in the marketplace that are that have come along after we started this, that we even partner with, that I think are great opportunities. So I won't go too long here. So market to potential sellers with assumable mortgages to secure more listings. Obviously, none of this is going to be rocket science, but reach out to your past clients or your network with assumable loans. Highlight the value of assumable mortgages in a rising interest rate market. So anybody you helped that bought a home, especially prior to 2022, with a VA or FHA loan, probably has a loan below 3.5%, maybe as low as 1.75% if they bought right at the right time or refinanced. So if they've got that, that makes their property unique in the marketplace. And if they're thinking about selling, they may have something that can really move their house. Use social media to educate homeowners on assumable mortgages. Link our content to your pages if you need to. Create educational videos or posts that explain the assumable mortgage process to the public, showcasing your expertise. You're here today becoming an expert. Use farming tools to identify properties with assumable loans originated or refinanced in the last few years. Primarily, the best rates were prior to March of 2022. Market directly to those homeowners for potential listings. Your title rep can usually assist you in targeting the right audience. Teach classes to homeowners about the value of their assumable loan in a rising rate market. We have attended some classes in our local area here just to be backup for agents, but we'll help any way we can. You're welcome to incorporate the listing presentation flyer we have on our website at assumptionsolutions.com into your standard listing packet. Stand out from other brokers by partnering with Assumption Solutions. You can show your potential clients you have a national leader to help them through a transaction. All right, target buyers who could benefit from assuming a lower rate loan. Reach out to past clients or your network who may be the most payment sensitive. You could bring buyers back into the market as affordability becomes more challenging. I had clients specifically who were hunting in 2022 who backed off because of the rate change, and they were VA buyers. And I was like, buyers and sellers. And I was like, hey, you guys, just so you know, you have a special asset on your house and you're the most attractive person to do an assumption. And they came back in the market specifically just looking for this. Use social media to educate buyers about assuming mortgages. Share real examples of payment savings that can be achieved by assuming an existing loan. Feel free to use our examples. That slide about the value, when you show people the payment comparison, the savings through an amortization schedule, that kind of stuff on social media is brilliant content. We have seen so many people get buyers out of that kind of content. Collaborate with listing agents to promote listings, showcasing mortgage and payment details to highlight the benefits of low rate assumable loans. I know if I have a listing and somebody wants to promote it, I'm 100% behind them in whatever way I can get my listing sold. Listing agents, by the way, don't hide that info. Share it out everywhere. That's the asset that's being marketed, right? So work with the buyer agents. If they want to promote your stuff, let them. Engage with the veteran community, explaining how assuming a VA loan and swapping entitlements with another veteran benefits both parties who have served our nation. There are lots of organizations around around the country that are made up of veterans. Speak to that community if you can. Host buyer classes about the value of assuming a low rate loan in a rising rate market. You can use our content or have us co-teach with you if necessary. All right, now let's assume you get the listing, which I think being a listing agent is the best position because at the end of the day, when you have a listing, the goal is it sells, whether it sells via cash, via conventional loan, or via assumption. You've got the asset to market out. Now, I know listings may not be moving as fast as they were, but it's still, every time you take a listing, I would look at it as you've got the entire agent network in your market as your sales force out there to sell it, right? So use MLS fields for assumable mortgages. Enter details like the loan type, the balance, the interest rate, and the payment. Every MLS around the country is different. Some have fields for this, and some agents don't even know they have fields for this. The key is getting the stuff in there. You can put the interest rate, you can put the payment, you can put the balance. You're not quoting new interest rates, right? This is a fixed thing that will transfer with the property as an asset if somebody qualifies. Include the monthly payment in remarks that syndicate to public sites like realtor.com, Zillow, homes.com, whatever, and help buyers visualize the savings that they will realize by buying this house versus the neighbor's house, who maybe is the same kind of house but doesn't have an assumable mortgage on it. You want to you want to show that everywhere that buyers are looking. Ooh. Use social media to showcase the listing, emphasizing the lower payment versus similar homes without an assumable mortgage. Many Facebook groups can help with property marketing. There are groups regionally and nationally that are dedicated to this space where agents post stuff for sale, where buyers post wants and needs. If there's not one in your marketplace, maybe it's worth starting and hosting. It has grown to a big space to market property and to find property. Highlight the assumed mortgage and payment savings on flyers at open houses, sign writers, flyer boxes, anywhere that you're going to market this property. This, if you don't talk about this, it's like having a listing with a totally remodeled kitchen that you don't even take a picture of it or don't even mention it in remarks. This is a big deal. Now, the last thing that I think is very helpful, show buyers and agents that Assumption Solutions will assist with the process to ensure a smooth closing. Most agents have little to no experience with assumptions. I mean, it hasn't been a thing since 2022, right? And so a lot of times there's a bit of trepidation on the behalf of agents about getting involved in these transactions because they just don't have experience. Well, if you can say to them, hey, look, we have a third party that does this all the time, has done more than anybody else, will help us all through the transaction step by step so that we as agents can focus on what matters most, which at the end of the day is prospecting for new clients, new listings, taking listing appointments, doing showings, and writing contracts. But that's where we get paid. We do not get paid as real estate agents to sit on the phone with servicers in a phone queue trying to get an answer to a question. So if you can show them, hey, these guys will basically take the lead, hold everybody's hand, move us through this deal, you're going to have even more buyers agents who are willing to bring their buyers to your listing. All right. Now let's talk about some resources that are out there for you, and then we'll wrap this up and go into some questions. I will share one different thing to talk about some market depth in a sec. So our website, assumptionsolutions.com, it is a fantastic resource for agents, buyers, and sellers. Matter of fact, this class you're going to today, we will upload as a recorded class so it can be watched again. And it's a great class to send to your clients. They mostly only need the first half. They're not looking to get new buyers and sellers in the second half here. So use this as a resource for your clients. Now, the next thing I'm going to talk about is a website called Assume List. We at Assumption Solutions, we're not involved in the search space for property. But there's an agent out of Virginia who started a platform called Assume List. And we kind of partner with them. We obviously mentioned them. They refer people to us as well. I don't own them, but I love their website. It's a subscription-based search platform available in major markets, so it's not everywhere, with a direct MLS feed. It enables agents and clients to quickly find properties with assumable loans. The site uh, displays active homes marketing assumable loans, those that have assumable loans but are not marketing it correctly, and even homes with assumable loans not currently for sale, which can be used as a prospecting tool. So let me show this real quick. I'm going to stop the share on this really quick and switch it. All right. Okay, so this is the actual Assumeless platform. I logged in, and this is the map around the greater Houston area as I zoom in and zoom out, right? They're once again, they're not in every market, but if you look at this, what I've just got this on, I zoomed in on the map, and this shows over, if you look here, over 2,000 active properties in this market space that have a loan that is assumable. Likely, I think they cap it at like 5.5%, right? So just around the Houston marketplace, these are what's active. And if you look at these individual properties over here, it gives a little detail on it. The interest rate is down here at 3.2. They've got an estimate of the cash gap and stuff like that. So agents can build searches for their clients in this platform branded to them. I use it for my clients in my real estate company when I build searches. Now, it's not as robust as an MLS, but the cool thing is it doesn't depend on agents properly marketing it in the MLS. So it's a neat platform. But let me look at this here. If I click Assumable and I go to off market in the same space. So, Tammy, just in your area, there are 160,000 properties off market that carry a loan below 5.5% that could be sold assumable.
That's great.
So this it's wild. It's a neat platform. They have the ability to market to these people directly through it and stuff like that. If you go to assumptionsolutions.com, we have them linked on our website under the resources page. Um, they do a lot of webinars like we do. It's a great platform. So anyway, I highly recommend that.
It's
So
very cool.
let me take this back to the okay. And then we will wrap this up and go to questions. So love that platform. The last thing I'll do here before we go to questions, one more little laugh. It's a tough market. The best agents, though, they always find a way. No matter what's going on in the world right now, realtors are out there who wants to buy a house. So, all right. Who's got any questions? I know we got a small audience here, but who has questions on stuff that I did not cover?
You guys can unmute yourself. There's just a couple of you, so.
Okay, thank you. I have a quick question. I'm new to real estate, actually studying for the exams now and everything, but and I want to kind of specialize in this, so I definitely want to get the WFG information afterwards, so I can have that resource as well. But my question is the purchase money HELOC, in terms of doing deals that way, and the entitlement being staying with the property in a non-veteran acquisition for the assumable. If you've seen or if you know, what is it like to refinance that VA loan in the future for the second to come
Well,
off?
the second is not a VA loan,
Okay.
right? The second is a purchase money HELOC, which is not, it has nothing to do with the VA, right? Now, you would never, in my opinion, want to refi the first that you assumed unless rates had gone below it, right? So you're going to get that assumption completed. And I think if you're wise, you're going to keep that loan until it's paid off, whether you live in the home or not. If you move out, I would turn it into a rental. What I would target if I did a second is I would do everything I can. I would focus every extra dollar I can to paying it off as fast as possible.
Okay.
Because the faster you get rid of an 8 to 10% loan, the more financially you are winning.
The
Right.
less interest you
So,
pay. Yeah.
yeah. Now, once again, hopefully that second isn't too large, right? Because if it is, you probably should have just, done the new loan to begin with. Because if you're getting whacked with a 10% loan, you're probably not saving any money on your monthly payment if it's too
Right.
big.
Yeah.
Right.
At
Okay.
that higher rate. Yeah. Because a second lien is always going to be higher than an original first lien.
Right. Okay. Okay. Thank you.
Mhm.
Yeah. Anything else?
Yeah, I have a quick
Okay.
question.
Okay.
Thank you, Craig and Tammy, for this presentation. This is really, really helpful. My question is, can the loan servicer change the terms of the loan during this assumption process in terms of either the interest rate or the repayment period?
No, they cannot. That loan cannot change at all. It's a fixed loan when it was issued, and it's fixed until it's paid off. We have had people ask if like they have more cash than the gap that is actually there. And we've asked people or had people ask if they can pay extra down on the loan, and you can't do that either, right? The loan, when it transfers from the seller to you, is going to be in the exact state it is. Now, every time the loan is a payment is made, obviously the principal goes down on that loan. So while you're in the assumption process, your down payment can increase because every time a payment is made, the principal goes down. So when you finally complete the assumption from when you started, if it's taken 2 months, maybe there's been two payments, two additional payments of principal have reduced the balance of the loan. But the servicer themselves cannot change the interest rate, cannot change the loan balance, and the buyer, who maybe even has more money, cannot do anything to change it. Now, could you pay more down after you complete the assumptions? Of course. Will they recast it? I don't know. Will they do a recast on it? My guess is probably not, but we wouldn't be involved in that, and we don't see that happening. So
Okay, thank you.
you got it.
Craig, you may have covered this and I may have missed it, but can a loan be assumed more than once?
Good question. We don't see anything that says it cannot. Now, we have heard, I have seen somebody post in a group on a deal that we were not involved with that said the servicer made them sign a document that said it was not assumable again. But
Oh,
there's nothing in the VA guidelines that says it
it
can't
says
be.
no.
Now, we
Interesting.
haven't seen that happen yet because honestly, this space is 4 years old,
Right.
right? And I think a lot of the people taking these over, they're going to either be in that house for a very long time or they're not, they're going to turn it into a rental even when they move
Yeah.
out of it. So we haven't seen it, but there's nothing to indicate that it can't be, unless the servicer makes you sign something. And that's hearsay, right? What people post in some kind of Facebook group. We are
Right.
members of a lot of those groups, and the misinformation we see in those groups is pretty
Yeah.
large. So
Yeah.
I'm not gonna say it, but I don't see any reason it couldn't be.
Yeah. Just as higher balance homes, maybe.
Right. Yeah, that's what I was thinking too. Yeah.
Mhm.
Yeah, I mean, obviously, I think servicers would love if I mean, I know they would love if this goes away, right? We
Right.
even had a call. It's been so interesting being in this industry. So many things have come to us. Matter of fact, I got a call this morning for an interview I'm doing tomorrow with NPR, the radio. I mean,
Mhm.
I had a call from a mortgage bond
Wow.
rater, not rater, because they're trying to assess
How it'll
the
affect the
value of the
market.
bonds with the fact
Yeah.
that a lot of these loans might go to term versus get paid off early
Yeah.
and stuff like
Interesting.
that. And so, yeah, yeah, believe me, I mean, there's no shortage of interest at the servicer level for seeing 2.5, 2.75 rates get paid off.
Well, probably what you'll see is the servicers jumping into the assumption business just so they can do the second and get the other interest rate.
Some of
You
them
never
are.
know.
No, some of them are. Some of
Yeah.
them are. And I think if economic conditions stabilize more, you'll
Hmm.
see that grow.
Yeah.
We saw a lot of entities when we thought um, seconds needed to be assumable, trying
Mm.
to build out those products. Some big
Hmm.
entities talked to us and talked about partnering with us, and then all of a sudden that went away.
Went away.
And
Yeah.
yeah, so the entities that are doing them, they're doing. But you can check local markets. I would talk to your own lending pool and say,
Yeah.
hey, do you have a program for this? We know an outfit that does it. Barrett Financial does it nationally, but
There's a couple of places here in Texas. I actually have a lending background. So when I was
okay.
at the bank, we had a couple of resources that did seconds just for assumables.
Nice. Okay.
Yeah.
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 Yeah. I think that's a great connection to make sure you have in your back pocket as a
Hmm.
realtor, title company, whatever. So,
Yeah.
okay. Well,
Any
I
other
think
questions?
I think we'll probably wrap this up. I will make this on our website as viewable. And if anybody's got any questions, I'm very easy to reach through assumptionsolutions.com. If you call the office number, I'm usually the guy answering the phone because my role is protecting my multi-decade lenders touching files that they're just focused on deals, not answering general questions and stuff like that. So you're welcome to email us. I do see John had one last question. Yes, all FHA loans are assumable. If a loan is in default, that the loan usually will need to be made um, up
All right.
made current to get it to assume. But other than default, all FHA, all VA loans are just by nature assumable.
Got it. Thank you. Thank you.
Okay. All right. Well, thanks
Thank you so
everybody.
much, Craig. This was great information.
You got it. Have a great day.
Thank you, guys. You guys too.
Thank you. Be in touch. Thank you. All right. Bye bye.
Bye-bye.